Hello, everybody. I'm Jeppe Kirk Bonde, the most copied popular investor on eToro, and welcome to this 2025 Q2 quarterly investor update. If you want to use this presentation for anything, please go ahead and read the disclaimer at the bottom of this slide very carefully. So the agenda for this presentation is I'll talk a bit about my background, then my investment strategy, what I have in the portfolio now, and then go through the many questions that I've received in advance. So one of the reasons that more than 30,000 people are copying my investments on eToro is that since 2013, I've had an average annual return on investments of 24%, which is really better than anyone you could fairly compare with, and also with a better return to risk ratio. My background is that I started as a management consultant, advising some of the largest companies in the world, including in aerospace and defense, tech, banking, and spent most of my career in London. As I was doing that, I was making more money than I was spending, and so I wanted to invest my money. And then I started comparing all the different options that were available to me from my bank, my pension fund, and many different investment platforms, looking at how expensive are they in terms of fees, what is their website like, what's the app like, how secure is the platform, how is it developing over time. And I scored all of the different providers on these and then weighted how important each factor was, multiplied those up, ranked them, and then eToro came out as number one. And so I started investing on eToro. And then eToro has this feature where if you don't know who to copy or what to invest in, you can copy another user. And then many people started copying my investments. And then in 2018, I quit management consulting to focus 100% on managing my money on eToro and hired a small team to help me. And then 1 year later, I was number one on the platform. And here 7 years later, I'm still number one or 6 years later, I'm still number one on the platform. And today, 30,600 people copy my investments with 109 million US dollars. Now, I don't do everything on my own. I have a great assistant that helps me. I have a good network of experts that I trust on complex topics. If I invest in something, I must either myself be an expert or know someone who is. Then I get strong support from eToro. Whenever I have any questions or concerns, there's always someone from eToro ready to help me quickly. I subscribe to the best data providers and the best IT tools. And finally, I'll highlight my three favorite experts, which are my three brothers. One of them, he's the CEO of a large advertising company. One of them, he is an economist with the Danish Ministry of Finance. And one of them, he works with artificial intelligence and did his degree in computer science. So those are my favorite experts. If I have any questions or concerns in their areas of expertise, then that's who I'll go to immediately. My investment strategy is based on some principles that have been there all along and will continue to be here. I focus on macroeconomics, evaluating what kind of growth rates different pockets of the global capital markets can have going forward. I focus on mega trends. So these are trends that can keep at it and where things can grow by more than 10% for more than 10 years. I focus on fundamentals. That means doing fundamental analysis, really analyzing companies carefully. What is their management team like? What are their employees like? What are their products and services like? What's the technological level? What's their competition like? What are their strategic options? How might they fare in different scenarios? How have their financial statements been through history and how might they be going forward? And all of that is information that I use in order to value the company and calculate what do I really think this company is worth. And then I like to invest in companies that I evaluate are worth a lot more than their price would indicate. And there's a great quote by Warren Buffett who said that price is what you pay, value is what you get. And that I really subscribe to that view. Then I focus on the long term. That one's difficult for many people to really appreciate because, of course, if you're always right in the short term, the long term should take care of itself. But unfortunately, the people that focus on the short term, they are equally bad at doing well in the short term. They're just a lot worse at doing well in the long term. If you want to run your life or run a business or run an investment portfolio well, then you are really best off if you can kind of ignore all the things that 10 years from now, you will say those didn't matter and focus a lot more on the things that 10 years later, you would say, wow, those really did matter. And there's a great quote by Benjamin Graham, the author of the book, The Intelligent Investor. He was also sort of Warren Buffett's mentor. And he said that in the short term, the market is a voting machine, in the long term, a weighing machine. And that effectively means that in the short term, it can be important what other people think about what other people think. But in the long term, if a company becomes very big and profitable, then it'll probably also be worth a lot at that time. And if you found that early, it'll overall have been a good investment. And you just have to have the patience to wait around for that after you've made your good analysis. Then I focus on risk management. That includes diversifying across many different kinds of companies. Some that could do well in some times, and then others that could do well in other times. I hedge. That means that sometimes you have two companies that have some very different risks, and actually by having them together, those risks cancel out. So as an example, that's one of the most easy to understand. If you have an oil company and a shipping company, then if the oil price goes up, then that's very, very good for your oil company, but very, very bad for your shipping company because they have to, spend more on fuel. Vice versa if the price goes the other way. But then if you have both, you're sort of neutral towards the oil price, because if it goes up, well, yeah, that's good for one, bad for one, so you are okay. And if it goes down, well, you're good on one, bad one, so you're okay. And a lot of people actually, without really realizing, have made a big hedge in their life when they bought their first property, because you're effectively born lacking a property, and when you buy one, now you have met that need. And yeah, when people buy a property, that's usually when they start really caring about the property prices, which is a little bit ironic because it's actually when you don't own a property you should really care. Once you own one and you need one, those things cancel each other out. You effectively, if the price of property goes up, by a factor 2, then your house is worth twice as much. Woohoo! But your cost of fulfilling your housing need is also twice as high. So yeah, that's a way you do hedging, and you can do that with many different categories of risk for a portfolio. And finally, I do stress testing. So conducting a lot of analysis, coming up with lots of different scenarios, and evaluating how my portfolio or variance of it would perform in different scenarios. And the scenario could be something like, what if that thing from that science fiction book happens at the same time as that thing from far back in history? Oh, if those things happen together, then maybe these would do well and these not so much. Is my portfolio ready for that? What could I do to make it ready for that? Then finally, I focus on keeping the fees low. I don't use any leverage. I don't trade any high fee instruments. I don't do any high frequency day trading. I pay the same fees that copiers pay on eToro. So if I keep my fees low, then copiers keep their fees low. And keeping the fees low, in order to keep the fees low, picking eToro is already sort of a very good choice for that. And then on eToro as well, you can sort of make decisions that keep your fees lower. And by doing that, you're just getting more profit out of your money effectively. Then there are some areas where I see great opportunities. I like companies that have organic growth. That means that they are selling more products or increasing the prices of their products by more than the prevailing inflation rates. But it does not include companies that are just growing through acquisitions. So sometimes you can read at the beginning of the annual report that, oh, we grew the business by 2% this year. Then yes, that's because you just acquired another company. Actually, the core business that you were running for this time shrunk by 4%. So what you've accomplished is really unimpressive. On the other hand, there are some companies that acquire some companies for a low price, and then after the acquisition, they're able to actually deliver a lot of growth based off of it. And that part that comes after does count as organic growth. And I do sometimes like that a lot. Then I like companies that are resilient, that either have a strong competitive advantage they can sustain or have a clear path towards one. I like companies that have a strong balance sheet that can do well in different scenarios, and that can ideally protect me against some extreme risks. So if this thing were to happen, well, at least this company is there to protect me, and then I might have a lot of that because, well, I really need that in that situation. Then I like companies that are profitable, that create real profits, and especially if they're able to reinvest the money from those profits into themselves to grow that even faster over time. Sometimes you have a company that's really good, but it just cannot really grow much from there. And then that's you sort of have to take that into account in your valuation. Then I like companies that have a new company strategy, not just because well, it's not enough for me that they say they have a new strategy. They have to actually, show me somehow that they're serious about this new strategy that is really going to get implemented. It has to be, of course, be a good strategy, one that that I like. And if a company, for instance, sells off part of the business, changes the name, makes a strategic acquisition, this can be some of the signs that sort of inform me, okay, they're serious about this thing. It's not just some a document that won't go anywhere except into the bookshelf, never to be read again. Then I like companies that make great products and services, not just because because the best product and the best services, they often win in the long term. They can be really, really valuable if you're able to make the best products. If you're a smart shopper, you're able to go out and buy the right product again and again instead of buying the wrong product and having to return it or regretting your purchase decision. If you understand sort of which features are worth paying more for, where should you try to save your money, which which products are really actually the good one. If you're able to do that, then sort of that's one piece of the puzzle of understanding a company and whether it's a good investment that you've put into place. But if you don't understand products and services, then it's just impossible to understand businesses, and then it's also more or less impossible to understand if something's actually a good investment. Um, there's a great example of failing at that, where Steve Ballmer, the former CEO of Microsoft, he was holding up the first iPhone and laughing at it and saying, "Oh, it doesn't have a keyboard. It's way too expensive. I'm very comfortable with our position." And he was, of course, proven wrong by the massive success of the iPhone. But yeah, many people have recently done that with Tesla as well, and Nvidia, and yeah, maybe now with Palantir. So it's just a lot of the time people will not really appreciate the good product or service, even when it's staring them right in the face. I like companies that are mission driven, not just because I sometimes believe in the mission, but because it can be a great way to attract and motivate and retain some of the smartest, most hardworking people without overpaying them. There are some companies that are true magnets for talent. They just attract those kinds of people and manage to keep them. There are others where they truly have to overpay to get some good people and they still can't keep them. And if a company is in one end or the other of that spectrum, it might not show up in the financial statements next quarter, but it certainly will a few years down the line. My portfolio is almost entirely invested in stocks. I also have a property that I rented out. Many people are probably in the same situation. And that makes good sense because historically, stocks has been the best overall investment category, delivering 7% real return per year, which is equivalent to doubling the value of one's investment every decade. And property has been good historically. I think it's a little bit less good now, but still good. Bonds have been okay historically. Now I don't like them too much. When I look at the different interest rates I could earn on different bonds and compare that to the expected inflation for those matching periods, it's really not impressive. So most of the time when there's a company and they have a stock and a bond, I just much prefer the stock over the bond. And same for investments in government bonds or bond funds or anything like that. Commodities have historically not done much. They have done something in the past few decades, but if you sort of look at the longer periods of history, then not really. Effectively, if you had a gold bar during the Roman Empire, then you would have kept that gold bar. That gold bar would have remained one gold bar, and today it would still just be one gold bar. Contrast that with a company, which is sort of like a living, breathing organism that can grow and grow and grow and grow and grow. That on average just grows and becomes a lot bigger, which commodities just don't. And property is a little bit in between, but fundamentally, you can earn rental income on a property and you can reinvest that, and thus a portfolio property can grow over time as well. Portfolio for commodities generally does not grow like that. Currencies have historically been terrible, especially during some of those periods of hyperinflation. The Deutsche Mark was a very popular currency until the crash between the wars, where it lost all of its value, even though that was from a big economy. And at other times, currencies have just hit a medium level of inflation, which has been terrible as well. But overall, currencies have been terrible historically. They're terrible now, and I think they will just continue to be terrible. Then there are some big factors that really drive economic growth for the long term. And I like to look at those in separate spaces. So in the physical realm, in the social realm, and in the technological realm. So if we start in the physical realm, I analyze nature. How many trees are there in different places? How much oil is in the ground? How much of different metal ores do we have in different places? I focus on life, animals, but most importantly, humans. What are the demographics like in different countries and regions, and how are those changing over time? The companies that have the right products for the right demographic segments in the right places, of course, have an advantage. Then the realm in which the most value can be created or destroyed the fastest is in the social realm. So if you have a US dollar bill or a number on a screen, maybe a paper that proves you own your property or anything like that, then those are all really social constructs. If we believe in those, then we can use those social constructs to transact with one another, to cooperate. And it's that cooperation that really creates so much value year after year after year, that's a massive amount of value in total in the world. And if that trust disappears, then a lot of value creation can disappear very quickly. Then we always have to ask ourselves why anything really does have value. If you look at a house, it's very obvious to many people. They don't even question it why a house has value. It's made of brick and mortar. It's very tangible. Obviously it has value. But hypothetically, if humans didn't want to live in houses and didn't want to look in houses, and people just wanted to, be nomads living in tents, then houses would not have any value. So it's from us that something is able to have value. And sometimes what humans value changes over time. And if something's changing at a rapid pace, even if it's in a small part of society, that can suddenly spread out to everywhere. And if you can get in early on that, that can be the basis of some very good investments. Then finally, the technological realm drives a lot of economic growth over the long term. The most important ones have been the big foundational technological revolutions, going from hunter-gathering to agriculture, through the industrial revolution, getting to the internal combustion engine, then electricity, the computer, the internet. And now we are living through maybe the most important technological revolution of all, artificial intelligence. Then there are also important innovations happening all the time, where it's just companies that are doing little things better and better and better over time. Not any major revolution, but people at home are finding, that they prefer this product over that one. People are finding that they can just use this in a little bit of a different way and it's better. People are watching some guides, getting smarter. Companies are finding slight ways of doing things better. And if you have some companies that are just doing things slightly better and better and better and better all the time, then that can really add up over a few years. And if two companies, are more or less tied now, if one of them is doing that, then they can really, create a difference towards the other one a few years down the line. Then from those big factors that drive long-term economic growth, we can look at where the economy is right now. So in terms of GDP growth, things are quite okay and forecasted to be quite okay, although large investment banks, IMF and others, have reduced their forecast after the announcement of Trump's tariffs, and also as we sort of see now that he's adding more tariffs, as he's also removing some and opening negotiations, but also closing some negotiations. So it's sort of, there's a wide room there for potential different outcomes, but also based on what outcomes we're seeing, potential to adjust based off of that. Unemployment rates are quite fine. They're generally lower than before COVID, which is really nice. So that's sort of something at least to hold on to in terms of the economy, and puts the treasury and the central banks of different countries in a good position to start with. Interest rates are at a reasonably good level. They are lower than they have been throughout history on average, higher than they were, of course, when we reached negative interest rates after the financial crisis. But so they've sort of come to a reasonably good level, which is nice. Then inflation rates were almost coming back down to the target of 2% in the major economies. But then now with the tariffs and the potential threat that central banks have to do something to respond to this, that sort of means that maybe we will not get in gold here. That's unfortunate, maybe central banks were really eyeing that in a couple of years they would sort of have been victorious of what some call, landing the plane softly. But yeah, now maybe it will be more challenging. Then there are some mega trends that I've identified as extra interesting. If a company is driving or riding the wave of one or more of these mega trends, then it's more likely to be found in my portfolio. So firstly, I really love many companies in the category of the nice to haves. When we humans, we have it all. We like to compete with each other in fun games and who can look nicer in better fashion. And there are some companies that are delivering great profits and great growth within these categories that are to be found in the portfolio. But if you have a portfolio that only consists of nice to haves, then you put yourself in quite a dangerous spot if suddenly the world turns sour. These nice to haves can only stand on the shoulder of the need to haves in the real world and also in a portfolio. You need in the real world to have security and to have energy. Otherwise, these other things fall away. And in a portfolio, it also works that way that these things kind of protect the others a little bit. They tend to do well in different world scenarios. Finally, there are the enablers and accelerators. So these are the things that help us do all these other things faster, better, cheaper, smarter. Chief of these is artificial intelligence, the major technology that's happening now. And the companies that are most likely to make the most profit from this over the next years, they are to be found in the portfolio, along with the companies that are making and will in the future make the amazing tech devices that we're going to be using. Then, if you want to compare some companies in a nice, quick way, a great way to get an overview is using the multiples. So this is an example with the Magnificent Seven, the seven large US tech companies. And if we look in the top left corner, we can see that all of them have reasonable profit margins. Nvidia is looking very good. Microsoft looking very good. But Tesla and Amazon are lagging quite far behind on this one. In terms of growth, Nvidia is absolutely skyrocketing. They are just growing that company massively, and that's really amazing. But Apple and Tesla are lagging a little bit behind. For these two top charts, the higher the better, because they're about profitability and growth. But for these two bottom ones, the lower the better, because they're really about price. If we look at the bottom left corner, we can see that for every dollar of profit that Microsoft brings in, we have to pay $27 as investors. That's sort of fine. I mean, they are growing it as well. But if we look at Tesla, we're paying $126 for every dollar of profit they bring in. So we only want to pay that much more for Tesla if we believe that they can improve their profit margin in the future massively or get back to a good growth rate again or something like that. Otherwise, we would consider that too much. In the bottom right corner, we can see that for every dollar of revenue that Microsoft brings in, we pay $12 as an investor. Well, that seems pretty sensible given how much profit they get out of every dollar of revenue and how much they're growing it. But if we look at Nvidia, we're paying $21. Sensible because they're getting more of both of those. But if we look at something like Amazon, we're only paying $3 for every dollar of revenue, but they're also getting a lot less profit out of every dollar of revenue and aren't growing it as much. So that's sort of a great way to get a quick overview of companies using the multiples. Then the analysis that I do most every day is discounted cash flow analysis. In this, I take a lot of data. They come from many different data providers as well as my subjective insights. So these can be, my evaluation on how good a company is at something on a scale from 1 to 10. So that would be subjective, but it would be numerical. So it can be used in my models. Then I make my financial models, which are my valuations. So I automatically value thousands of companies and then with a lot more customization, value a couple of hundred companies. And then I evaluate how valuable are these companies compared to how much they cost and rank them. So the ones that are the most valuable compared to the ones that cost are the ones that I want to have in my portfolio in a risk sensible way. And to get it in a risk sensible way, I have to review how all these companies fare across different scenarios. So if this were to happen, how would my portfolio fare? But if I were to make this change, what would it look like instead? If I were to what kind of change could I make in order to make it safe in this circumstance? And then with those taken together, I can make my decisions. And my decisions are most often research decisions. So there is maybe a new company I need to learn more about. Maybe there's a new technology I need to learn more about. There's a new methodology of valuation I need to learn more about. So anything then I do on my research, maybe that caused me to change what input I want to get. It caused me to change how I want to value companies. That caused me then to say, oh, now I should maybe look at this company instead. Let me do more research on that. And then as that cycle sort of spins, I continue to learn, I continue to value companies better. And with every company that I've valued, I've always learned something new. There's something unique about every company, and you sort of find out what that is and learn about that, then you can sometimes use that knowledge also when you're then valuing other companies after. For instance, when I invested in Facebook many, many years ago, I didn't just learn a lot about Facebook and that Facebook was an amazing investment. I also learned about social media advertising, and I evaluated what kind of companies are advertising on Facebook. Is this the smart companies or the dumb ones? Oh, it's the smart ones. Maybe when I value other companies, I should put in something about how they're doing with the social media advertising. So and that maybe that'll help me make better investments. And turned out it would. And for every company, there's something like that. Basically, that I learned that by analyzing that company, but I can use that when valuing other companies in the future. And then besides more research decisions, I make my investment decisions. So if there is a company that I have that I don't think I should have anymore, then I have to sell that. There's another one I should have instead, add that, sometimes just adjust. I want to have slightly less of this, slightly more of that one. And then when you add up all those investment decisions over time, then those taken together are, of course, my portfolio today. And my portfolio today is invested across 59 different assets, and the largest ones are in NVIDIA, TSMC, Iberdrola, and the largest one making up 7% of the portfolio. You can always see my portfolio on eToro. Anybody can see it, and that's publicly available to see what I have at any given time. If we compare my portfolio to the US economy, in the US, it's not just one industry that has all of the economic activity. There is economic activity and great investment opportunities in many different industries. In my portfolio, I'm slightly more invested in tech, energy, finance, health, and metals. In terms of geography, I'm slightly more than global average invested in North America and Europe, and less in Asia, especially less in China. That was my presentation. Thank you very much for watching. And now I'll go through the many questions that I've received in advance. So firstly, what do you think about defense stocks? So I really love defense stocks. When I started out my consulting career, aerospace and defense was one of the industries where I was advising some very large companies. And before Russia attacked Ukraine, I invested a lot into defense. At the time, there was a lot of large institutional investors who had this wrong idea that it was unethical to invest in defense stocks. And I sort of made my own evaluation of that and said, is that really the case? And I thought to myself at the end of that evaluation, you know what? You can't defend your country without defense companies. You can't just have the government produce the weapons either, because that's highly inefficient, because so many projects have both civil and defense purposes. So it's really the best way to organize it. And there are many so yeah, it would be unethical to not invest in this industry. And so I've had many very successful investments in this industry, and it makes up a decent part of the portfolio today. And it also has the advantage that war is one of the worst things that the world can go to, and if it does, then at least our portfolio will be a little bit safer than otherwise by having defense stocks. Do you invest in SP 500 stocks? Yes, I have several S&P 500 stocks in the portfolio. I also have a little slice of the S&P 500 ETF. So that means I have a tiny slice of each of those companies, each of the 500 companies. For the majority of my portfolio, I do prefer to pick out the specific companies to say I want to have that one, that one, that one, and not all the rest of them. But I think it's a good index. And it's looking nice right now. What are your strategy principles for investing? So I think I went over those already in the presentation. And I think if you just have to take like what is really the key, that's like it's long-term fundamental analysis. That's really my core principles. And if you want to add to what I said in the presentation earlier, I would also add that my sort of niche area to an extent is the intersection of technology, finance, and politics. My dad, he was a member of the European Parliament for 29 years. Growing up, I thought I would go into politics as well, and so I learned a lot about politics, and so I have a good understanding of politics. But then I did my my education at university and my certifications, and worked with a lot of banks, got a really good understanding of finance, and finally I have a deep passion for technology, which I've been using all my life, including programming a lot. And so sort of I've found in my career many people who understood, for instance, finance and technology, but they just did not really understand how politics change over time, or how like a law gets made. And I found people in politics that understand politics and finance, but then they don't understand technology. And so there's just so many times where people understand two of them, but not all three. And so there's maybe not that many people who have a decent understanding of all three. And that's sort of so the companies where you sort of need to understand all three to really value them, that's really where I think I've been able to shine the most and should be able to continue to shine the most. What do you think about the US dollar versus the euro? So, I think sometimes people think that I don't care at all about currencies because I just ignore them or don't think about them. But I have thought a lot about currencies and made my portfolio in a way where I'm quite protected from any negative things happening to currencies, such that I don't have to care about it. So it's not that I don't care about currencies because I'm just forgetting about them. It's because I've set myself up in a way where they won't matter to me. So that's sort of a different angle of it. Ultimately, um, if you are invested primarily in bonds or have a lot of cash, then you are hugely exposed to changes in currency rates. Ultimately, a bond's going to pay you a fixed amount of US dollars. And that means if those US dollars are worth a lot less, well, you're just getting less. And for a lot of pensioners, for instance, that have almost all of their money tied up that way, that simply means they're getting eaten out by inflation. But companies are generally able to change their prices. So if there is a declining value of a currency, then they can say, oh, now we can sell more because our products are cheaper, so we can sell more. Okay, you can also raise the price, then you'll sell less. You can calculate where you will optimize your profits based off of that. So companies are nimble, they are agile, they can respond. You can't necessarily change your price every day in every industry. There are different ways to change the prices in smart ways. There's like strategic pricing. Um, but companies are just able to do that, and so they are a lot much less exposed to currency rate fluctuations. And many of the companies that are very exposed to currency fluctuations, they generally hedge to a small extent. They don't always hedge fully away the currency risk, but they'll do it to a reasonable extent. So you sort of, even when investing in a company, you're getting a little bit of that. And then if you have companies that are making their money and spending money in many different currencies, you also get some diversification across currency risk. And yeah, that's my general view on towards currencies. I think I think there's a lot of action been taken that are working to weaken the US dollar. One of the world's best economists also made a good case against the dollar yesterday, which I found quite interesting. But I'm not going to deploy any of my capital to try to be a currency speculator. I prefer to sort of keep that as something that I'm trying to be a little bit neutral towards and neither get a huge benefit or drawback from. Why is the minimum to copy you $20,000? So after the amount of money copying my portfolio reached 100 million US dollars, eToro implemented this minimum in order to sort of maybe keep it less crazy that there would be so many people copying me that it just adds more complexity. I think that's the primary reason. As a portfolio gets bigger and bigger and bigger, it also gets more difficult to actually find enough stocks to buy for everyone. So when we buy, we have to buy for everybody simultaneously, and that can sometimes be a huge order, especially if it's for a very small company. So that has to be taken into account as well. And yeah, what is your opinion on quant investing strategy? So this is you can of course run as many analysis as you want all the time. So there's absolutely only positive things from having a lot of calculations running all the time, giving you nice analysis. But there's another thing to be trading with a high frequency, saying like, now we have a new analysis. 1 microsecond later, we have a new analysis. 1 microsecond later. It's very hard to justify the fees you pay for those kind of strategies. There are some, and there are a lot of people trying to do this that are sort of competing the profits from it far down. For an invest, generally, if you have a very large investment fund, then there are a lot of disadvantages. There's a lot of disadvantages to scale. As a most extreme example, when a famous investor, he had a small fund. He invested in a pizza company, and he made a big investment in the pizza company. And then the pizza company became very successful, and his portfolio did very well, partially thanks to that. But now he's managing a very big portfolio. And if he wanted to buy that company, it would only make up a small percentage of his portfolio. And then, of course, he would not be able to get that high return from having spotted that stock. So that's a huge disadvantage for that. However, if you're a very big fund, there are some things you can do. For instance, if the Norwegian oil fund, they have to sell a large stake and they try to sell all of it at one point, they might get worse prices than if they use a nice algorithm to calculate how small or large chunks they should sell it to and how much of the setting they should try to keep secret in order to sort of get better prices. And that's a way they can sort of regain some of that lost advantage from being that big. And for that, you need to either yourself engage in some quant investing strategies or hire someone who will do that on behalf of you. Um, yeah. What is the future of crypto in your opinion? I'm not the biggest fan of blockchain, but I am a big fan of private currencies. And I think that there's a lot more political and regulatory goodwill towards crypto now that can potentially be harnessed to create something really nice. In general, there are a lot of projects that I think are complete trash, and there are a lot of good projects that still have a coin. And even though the project is cool, the coin is still trash. And I don't really have much right now, but I have Coinbase, which potentially could be one company to benefit from this going fully mainstream. And also Riot Platforms, which mines and owns a lot of Bitcoin. What do you think about XRP, Ripple? Yeah, I don't like it at all. I think it's sort of I don't really think it has any purpose, and I think it's just a speculative coin that really won't go anywhere. What do you think about Ondo Finance? I think the company itself is really cool, and I think there's a great future for yield coins. But again, if you buy the Ondo Finance coin, you're not really getting a stake in the company. You're not entitled to any future dividends. You just have the right now to vote over changes to the system. And so you basically just have the right to volunteer to help them with your opinion. You don't really have anything really useful to have. So I think it's I don't know if sort of like if Nvidia, the stock company, they launched a coin called Ncoin that gave you absolutely nothing, you would be a bit like why would I buy that? Like I want to have the Nvidia stock. I don't want to have a I just don't want to just have some coin that allows me to give some feedback over what they should do with the product. Should we avoid the Magnificent Seven now? No, I think in general they're very good. I think it's very I think many people sort of assume like, oh, if some companies have become very big, then they must get smaller in the future because things go up and down. But one of Warren Buffett's most amazing features was he bought a lot of Apple when it was the biggest company in the world, and then it just became 8 times bigger. So that was quite amazing, right? And just because a company is big doesn't mean it cannot become much bigger. And I think with AI coming in, I think some of these companies in the Magnificent Seven will become a lot bigger. And some of them might even reach the point where they can just start killing other industries and just take business from them and say, right, you're doing that with humans out in the real world now. We'll do that with AI. Thank you. That's our business now. And now that's our business as well. And if they start doing that, they can become much bigger. So I think it'd be very scared to not have these companies in my portfolio. What returns do you expect in the upcoming 4 years under Trump? So I think now there's a lot of sort of turbulence from the tariffs being mentioned, negotiated, and then eventually potentially implemented fully or partially or in some variant of that. And there could potentially be a recession causing many companies to have lower profits for a while. But I think sort of look over the full 4 year period, I think it's all going to be very good because we have fundamentally this technological shift of AI that's just driving so much productivity and enabling so many companies to make so much more profits that and you're not paying that much compared to the existing profits and growth without that. And then with that, I think it's sort of a really nice time to be invested in the stock markets. And I don't think that the sort of bad things that the politicians can do to the economy is really a strong enough force compared to this underlying technological shift. What changes did you make following Trump's tariff announcement? I've made a few changes over the past months. In general, though, this has been quite an amazing year for me in the sense that the market has declined by 3%, but my portfolio's gone up by 3%. So it's quite a difference. And that's really sort of when I have a better performance than others over the long term, it's not just by having, a much higher return at different prices. It really is nice when the market is down that I'm up. That really, and the partial reason for that is that I have thought through many different scenarios for tariffs, protectionism, conflict with China, conflict with other neighbors before. And my portfolio was therefore quite nicely set up for that, with less companies that are really relying on shipping and yeah, doing things that would be much harder hit by tariffs compared to other companies. So I think that's yeah, that's been really nice. Do you foresee a recession? And if so, how are you preparing for that? So I think it's quite likely, but not the most likely outcome. But we could also sort of, one thing is if you go, say you go 2 consecutive quarters of minus 0.1% GDP, that's technically a recession, but it's so close to zero that you would just call like that's just a stagnation. Like there's just nothing is happening. And if you have 0.1% and 0.1%, that's really also nothing happening. And I think we are sort of, we might go slightly below nothing happening or slightly above nothing happening. We are sort of a little bit close to nothing happening. And there are so many tools that the central bank and the treasury can use. If things are looking to go just below the zero, then Trump can slow a little bit down with the tariffs, or the central bank can decrease the interest rate or announce some kind of hint that they're going to do it several times in the future. And with those sort of levers that they can adjust, I think it's quite possible to avoid recession. What do you think about options trading? So I don't think it's something that most people should be interested in. Ultimately, you often just end up paying more in fees. And if you're using options for shorting, that's probably on average going to take your returns lower, because on average stocks go up, on average stocks don't go down. So if you're a shorter stock, then you're on average losing money. And hypothetically, if we get put options on eToro at a very low fee, maybe I'll start using them, and then it will sort of be a different style of investing I have to engage in. But yeah, maybe to a small extent that could be worthwhile. But in general, I don't think it's something that most people should really be concerned about or try to get into. It's sort of a niche thing that not super important to get into. Can you please comment on your worst performers, including Kering and Vale? Yes. So both companies have sort of a thing that's gone wrong in common, and then a sort of separate thing each. So for what's gone wrong for both of them is effectively that both of them were selling a lot to China, directly and indirectly. So Kering, which makes luxury goods, luxury fashion, was selling a lot to China, and they're buying less. And Vale, it's a mining company, and the number one mining product is iron, and iron is primarily used for steel, and the number one customer of steel was the Chinese construction industry. And so as that sort of started to decline, steel prices started to decline, and Vale got lower prices and volumes of iron shipped out, and that has not been good for them. But then in addition, there are some unique things. I think Kering has been mismanaging some of their properties for a while, and now they're doing a lot of work to sort of reset that, and that's taking longer time than expected. And for Vale, they had some environmental disasters where the cleanup and legal costs have proven much higher than previously expected. Could you generate higher returns by concentrating on fewer stocks? I could not do a better return to risk setup by doing that. I would just be taking a lot more risk potentially for a little bit higher returns, or saying yeah, so I'm always betting that there could be a different scenario in the world where it's like, oh, now actually these 5 companies or these 10 companies, they're just going to do so much better than the rest, and they fit together risk-wise that I can just have these ones and ignore the rest. But that's not the situation right now. Right now, I can very nicely reduce my risk without really sacrificing returns by having the amount of companies that I do. And so, yeah, I'm not really inclined to try to concentrate. It's not a goal in itself to be concentrated or not concentrated. It's about evaluating risk compared to returns based off of what's there in the market to buy. So that was my presentation, and thank you very much for watching. Thank you very much to everybody who asked questions, and let's have a great quarter.